And then the rand, I was talking about it being at 9.11, 9.12, that band. And in fact, a moment ago we were saying it touched 9.20 earlier today, and it's now at 9.25. So we really are looking at lows for the rand that we haven't seen for some years. 9 rand 25, 9 rand 24 as we speak there at the moment. Well, now looking at global markets, I'm joined now by Mia Kruger. And Mia, the one company that we've got today which is of interest to start with is AFGRI. That's that food and agriculturally exposed company. I saw that their revenue was up 4.4 billion from 3.6 billion. That's quite a big jump in revenue. Does it filter through to some of the other numbers like earnings and profit?
Well, we actually saw their headline earnings decrease because they have that cost pressure coming through, especially on their poultry business. But we can discuss the segments now. I thought that I was quite happy with the fact that they increased their revenue by 17.5% over this half. And like most of the poultry businesses, the poultry is a very big part of AFGRI's business, around 45% of their revenue base. But it only contributes to about 10% of their profit because of the cost pressure and such a low margin that they're seeing there. They also mentioned today that the fact of cheap imports and so on, if the government doesn't do something substantially about it soon in the way of tariffs or quotas, they won't be having that business any longer, and they'll have to do some serious write-downs there. And I mean, that also filters through to other of our poultry businesses.
Is there any chance of that? I mean, we've had Astral, we've had Rainbow, all squealing and complaining, and it doesn't appear that anything has been done or is about to be done. Could we see the disappearance of the South African chicken industry?
Well, it's very difficult to say at this stage. At this stage, it doesn't look very good for that industry. There's a big squeeze on their margin, and it's not profitable for them anymore. We see inflation coming through in the likes of electricity and higher food prices or feed prices, and those are all substantial cost pressures which these businesses are based on. So we'll have to see some intervention from government coming soon.
Let's look at AFGRI if you were an investor and you're investing in a company which is exposed to chicken. Now, I would think AFGRI is a better bet because it's not all chicken, whereas Rainbow is by definition chicken, so they are most exposed. What's the rest of AFGRI's business look like?
Well, AFGRI actually does very well in the equipment sales. They're the sole provider of John Deere in Africa. So going forward, we think that will be a big driver for this company. They've actually increased their profit base or their profit margin on that business now over the last 6 months. Also, the financial services business is very profitable. They focus on commission-driven business there, and that has a substantial profit-driving margin for them, together with their silos and their grain keeping. Now, those two businesses combined actually have a profit margin of around 50% for AFGRI. So hopefully they'll be able to grow that base for them. And I think this is still a company that it's a small cap. It still offers relatively good value. They pay a dividend of over 5%, and they're still trading at a PE of around 10 times. So going forward for the long-term investor, this might be something that you want to pick up.
So it's one of those equations: small company, big growth prospects, relatively low PE ratio, and a solid dividend. So it's a nice mix at the moment, isn't it? Let's look at the retail sales numbers. They came out, and perhaps we can look at some of these shares today. Saw Mr. Price was down by 2.6% there. That's one of those that are down. ShopRite down as well, food retailer as opposed to clothing retailer. So let's just look at the retail sales numbers first, and then let's look at some of those companies.
Yes, we saw the retail sales numbers come out today, and it was down with the revision there for January, 1.9% lower. And we saw initially that these companies traded down substantially, over 3%. They've recovered quite a bit since then. But I think it's not a good story for the retailers going forward. We've seen those prices being driven up substantially over the last 3 to 5 years by foreign investors, local investors, and everyone actually chasing that price up. Those price earnings ratios for those companies, the valuation metric that I like to look at for retailers, are actually around double what their long-term average price earnings ratios are. So nothing that I would be looking at the moment, and we've actually seen some price decline over the last couple of months, 3 months to be specific. I think there's still a lot of pain for these companies to be taken, in the sense that we've seen that the consumer is still under a lot of pressure. the high debt levels of consumers in South Africa is still a worry for me, and I won't be an investor in these companies sometime soon.
Although there is still growth. I mean, a lot of these companies were punished, and the one that stands out for me was Shoprite earlier this year, where they had 13% growth, and people said, no, that's not good enough.
You're right.
There are other periods where 13% growth, people say that's double inflation, that's not bad, that's a good stock to have. So in a way, everyone got used to these not astronomical, but huge earnings increases in percentage terms. They're still profitable, they're still making good money, and in fact are still paying good dividends.
You're right. As a business, they're all strong and they're all doing good business, and they're all actually still very profitable. You look at double-digit growth in their earnings, but if you look at it from an investor side, the price you are paying for these companies are just too high, and they don't justify the earnings that you are actually buying in these companies. So if you actually hold these companies from a long time ago, I wouldn't be a seller of them necessarily. If they go to an overweight position in the portfolio, you might take some profit, but it's still good companies that make profit. Unfortunately, they're not justified. The price isn't justified by the underlying earnings. I think if we look at the earnings that just came out for all these companies, around 88%, that's the number that they worked out, disappointed the expectations of the market in earnings coming out. So I think, you know, the public and the investors were actually expecting higher earnings to support those prices, and that didn't happen.
Well, maybe this is the turn that everyone's been predicting. If you had to choose one of those retail shares, I suppose, would you go for food and would you go for clothing, just to take two sectors? And if so, which of them, and which company is offering the most value in terms of an overvalued sector at the moment?
Well, offering the most value, I'd say Spar and the Foschini's group are still trading at the cheapest levels there, and it's still profitable businesses. But I think I'm still a holder of Woolies in some of our portfolios, and I think that's still a company that I would hold because it's on a very specific, focused on a very specific consumer and doing good business. And they also have some, you know, exposure in Australia that's actually been doing much better than anyone expected. But all those businesses, like I said, are still good businesses, not the right time to invest in them.